In today's video, I'm going to show you the difference between a fixed rate and an adjustable rate. And at the end of this video, you'll be able to decide which one is best for you. My name is Duane Vizinau. I am a national wholesale lender and certified government underwriter. Let's go ahead and get into it. So let's first start off with talking about why this matters. So the interest rates affect your monthly payment and total loan costs. And 100% by choosing the right type can save you thousands over the life of your loan. Now, first, we're going to talk about the fixed rate mortgage just because it's a little bit more simple, but I'm going to get real in depth on the adjustable rate. So the fixed rate mortgage is an interest rate that stays the same for the entire loan term. So essentially, you know what your interest rate is for the 30-year loan. It'll never change. And this provides you with a predictable monthly payment. You know, in year 20 and year 30, what your payment is going to be because, again, it's fixed. And this is tied to your principal and interest, not your taxes and insurance. And this is good for long-term stability. You feel comfortable, you feel stable in knowing that your payment won't change. And for some individuals, that stability provides security. Adjustable rate mortgage. Well, the adjustable rate is an interest rate that starts lower but can change over time. So depending on which period you choose, whether that be the 5, 7, or 10, it can be followed by adjustments, and therefore the payment can change after the term. Now, the rate will adjust based on the market index plus the margin. So the index, and I have some here on the screen, the SOFR is an indice used for the 5-year arm, and the prime is typically used for lines of credits. But the margin is set by the lender, and that's going to be pretty much how they profit on the loan is the margin. And that will not change at all. Only the index can change. Now, this can result in lower initial payments, but it can actually also result in lower payments after the adjustment. It just depends on how the market is performing. Now let's talk about the caps and indices that are tied to the 5-year arm. And the index is going to be the SOFR, Secured Overnight Financing Rate. Now, when I did this video, the rate was at 3.65%. Now, the margin is going to be 2.75%, and this is fixed. It will not change. Now, for an adjustable rate mortgage, there are caps associated. So the caps will be a 2% initial cap, periodic 2% cap, and a lifetime cap. And I will go over each cap. So again, you'll have a better understanding of how it works out and what your payment will look like should you select the adjustable rate. Now, this is a 5-year arm. So that means after the 5 years, you will see some adjustments. The 5-year arm starting rate. So this is called the fully indexed rate. And this is what your interest rate is going to be the day you take ownership of the home. So the formula used here is the SOFR plus the margin. So for example, when I pulled this, the SOFR was 3.65%, and we're just using a margin of 2.75% set by the lender, and that equals 6.4%. Now, this is called the true market-based starting rate. Your rate will be this rate for the next 5 years. It will not change. Before we move forward, if you're seeking to get pre-approved, I would love to assist. As a wholesale lender, I do offer both fixed and adjustable rates, whether that be for conventional loans, FHA loans, VA loans, or even jumbo loans. So you can scan that barcode on your screen or go to my website where you can also chat with me directly. Now I'm going to get into all the caps, and the first one we're going to start with is the initial adjustment, the 2% cap. So this cap will limit the rate change after the fixed period. So know that after the fixed period, which is 5 years, this 2% cap prevents the loan from exceeding 2% above whatever the market rate was when you started. So this will be based on the market SOFR rate. However, that indices move up or down will change your rate. So for example, here we have 6.4%, which was your starting rate. Now, if the index went up 2%, then the maximum rate it can get to is 8.4%. It cannot exceed this amount on the first year. And this protects you from having such a large increase. So you won't see your rate go up to 20%, but it can go up to 8.4%, but it can also go down 2% as well, depending on where that index is at. Now let's talk about the periodic adjustment, which is another 2% cap. So this will limit the rate change each year after that first adjustment. So after this, each year, it can only go up 2% again. And again, this is based on the market SOFR rate, whatever that index is at that time. So for example, if your rate was at 7.75%, then the max it can get to is 9.75%. And this also limits the decrease. So it goes up or down depending on what the index is doing. And this just prevents payment shock year after year. You know what your interest rate, can be maxed out every year. Now let's talk about the lifetime adjustment, which is the 5% cap. So this limits the total increase over the life of the loan. So essentially, it's going to be again based on the market SOFR rate. So whatever the market indice rate was at that time or is at the time when it's adjusting. So for example, your start rate was 6.4%, then you add 5%, which means your maximum rate it can ever get to is 11.4%. So the rate can never exceed this limit throughout the life of the loan. Now let's go back over some of the things we just discussed. So the interest rate is the index plus the margin. And again, the margin never changes. That's set by the lender. It's the index that changes, not the margin. Now, the initial cap controls the first adjustment. So you know that was at 2%. Then we have our periodic cap, which controls the yearly change. And then we have the lifetime cap, which sets the maximum ceiling rate on the adjustable rate mortgage. Here we have a quick comparison that you can see between the two. So the fixed rate mortgage, fixed for the life of the loan, where the adjustable rate changes after the fixed period. The monthly payment is stable on the fixed rate, where the adjustable rate can vary after the initial term. Then the fixed rate is usually higher, slightly higher. We're not talking, a big difference, but over 5 to 7 to 10 years, it can add up. And the adjustable rate is usually lower. Now, the fixed rate is best for long-term homeowners. So if you plan on staying in the home for 15, 20, 30 years, then you may want to go with the fixed rate. But if you're a short-term or rate-sensitive buyers, if you know that you're just going to be in that property for 2 to 3 years or even 5 years, then why not look at the 5 or the 7-year arm if it's going to save you money over the life of the loan? But you just need to know whether or not you plan on being there in the long term. And the risk level on the fixed rate is very low, where the adjustable rate has moderate to high risk. Pros and cons of the fixed rate. So first, we're going to have some stability and long-term predictability. So for some people, just having that secure payment, knowing that you don't have to worry about the market and what the market is doing, because you never know what the market is going to do. But you can look up historical facts about these indices and see how they perform. And then you'll get an idea how they may be moving in the future. Now, the con on the fixed rate is it can have a slightly higher initial rate than the adjustable rate. So you just have to compare the two. Pros and cons of the adjustable rate mortgage. Well, the adjustable rate is going to have a lower initial payment, and which is going to be potential savings should the rate drop. Should the indice drop after the fixed period, like during the pandemic, some people had a very low rate during that time. So if the indice is going down, then you may want to look at the adjustable rate, especially if you're in a market where everything is inflated. Eventually, it comes down. It's just a cycle of life. Now, the cons on the adjustable rate are uncertainty after the fixed period. You don't know. So because of that, you may want to stick with the fix. But hey, you want to make sure you work with the lender who gives you both examples so you know which one is best for you, and an amortization schedule to show possibly what your payments can be like should they cap out at the maximum amount. Fixed rate versus adjustable rate. So my suggestion is just to look up, Google the historical figures for that index and see how it performed. And you'll see they typically follow the 30-year fix. So I hope this information was useful. Please be sure to comment below if you feel like I missed anything. Also, if you'd like to have a one-on-one Zoom consultation, you can scan that barcode. The link is also in my bio. It doesn't cost you anything. And please like and subscribe, and I'll see you on the next video.